We put together this presentation to talk about a set of heuristics and frameworks that we've developed over the past few years thinking about layer one blockchains that we think are really interesting and have been shaping our view of how to invest in layer one blockchains. The question that I want to answer today is, what is the best way to derive the value of a layer one blockchain? I'm not talking about price. You can go look that up on CoinGecko. I'm not talking about market cap. I'm talking about how can you actually value these networks. Before I show you how we think about it, I want to go over some models that have been popular in the past, that have gotten a lot of notoriety in the past that we think actually missed the mark a little bit. I remember when we started Multicoin in 2017, one of the most popular models that was used to value layer one assets was this MV equals PQ fundamental economic equation, basically saying monetary base times velocity equals the GDP of that economy. This really falls flat in a couple of ways. Crypto assets have properties beyond just payments. They're not just money. And while layer one blockchains exhibit a level of sovereignty, saying that they're as sovereign as nation states is just incorrect. Something that we've seen out of the Bitcoin community is the emergence of this stock to flow valuation ratio. And this is one that I think is just like really extremely wrong. You cannot create value or create wealth by just creating scarcity. There are lots of assets in the world that are scarce, but not very valuable. So I think stock to flow just like really doesn't work. Something that we've seen more recently with the emergence of DeFi, especially from 2020 onwards, is people looking at the total value locked on a blockchain and then comparing that with the market cap of that chain or of an application on that chain. And I think this is one of the most misleading metrics that you could possibly be using. It is very gameable. People game this metric all the time. And it doesn't correlate directly to revenue, really in any way. So we find this to actually lead to false precision that leads to bad decision making. And recently we've seen the emergence of proof of stake assets that offer you a staking yield for being a validator and locking up your tokens. We don't think this is a valuable way to look at valuing these models either, or valuing these tokens, because this is just a redistribution of ownership within the existing system. You're just changing the cap table, basically. You're diluting the people who don't stake, and you're giving more ownership to the people who do stake. So using this as a valuation framework is really weird. You can't really value an asset as a function of cash flows of the same asset. So there's a better answer, and we have three parts. We think that there are three types of assets that make up the majority of assets in the world. We have capital assets. These are income-producing assets. This can be things like equities or other productive assets that actually produce some income. There are commodity assets. So you can think of the traditional physical commodities, whether that's oil or corn, or you can think of commodities like Sol or ETH that let you pay for transaction fees and give you some utility when you use that asset. And we have money assets. Money assets are a store of value. It's a mimetic property of these assets that drives people to want to hold that asset, to store their wealth. And we believe that the right way to value layer one tokens is a sum of the parts valuation using these three components. Smart contract platforms exhibit all three of these characteristics. We're going to focus on the first one today, which is layer one tokens as a capital asset through the cash flows earned by MEV. I'll explain what that is in just a second. But in addition to that, You all are probably aware these tokens get burned to pay transaction fees. So that's your commodity component of these assets. And these assets are clearly being used as a form of money today. There are billions and billions of dollars of these assets being used as collateral on decentralized and centralized platforms that are using this as a store of value asset. The second and third point, fee burning and layer one tokens as money have been talked about very widely and I think are pretty familiar concepts to most of you in the audience. So we're going to focus on MEV, which I think has been significantly underappreciated by the market because it's a pretty complex thing. I'm going to try and boil it down. So what is MEV? And why does it matter? MEV stands for minor extractable value. The easiest way to think about this is if you are the leader in block production for a block on Ethereum or Solana or any of these other networks, you are God for that block. You get to decide which transactions come in. You get to decide the order of the transactions in that block. You get to decide which transactions don't come in. And that is all under your control. And I'll explain how that can be used to make very large profits in just a couple of slides. I want to say MEV is inescapable. There have been a lot of attempts, and there's a lot of people working on ways to try and reduce MEV or eliminate MEV. But MEV is a fact of financial markets in a decentralized world. And we don't see a way to actually eliminate it. It is completely inescapable. It's also not new. This has been around for a long time. We see this with high-frequency trading firms doing things like building specialized radio towers to shave milliseconds off of their latency communicating between different exchanges. We see these high-frequency trading firms paying exorbitant fees to co-locate their servers at the exchange in order to get a slight latency advantage. And amazingly, we're even seeing some go and create custom chips, FPGAs or even ASICs, that are running their trading algorithms so they can be just a little bit faster than the next guy. And we believe that MEV is the future of high-frequency trading in a decentralized world. The reason why these high-frequency firms invest so much into things like radio towers or custom chips or colos is because in traditional finance, exchanges fill your order first come, first serve. So latency is the key advantage. Latency decides if you're the winner or the loser for that trade. This is not true for blockchains. Like I said before, if you are leader of a block, you choose which transactions are in or out for that block, and you get to choose the order of transactions in that block. So that power is really shifting away from the latency optimizers to who actually controls stake in these chains. There's two types of MEV. The first is what we like to call benign MEV. This is the type of MEV that enables healthy functioning of financial markets. This is entirely inescapable, as I was saying before, because you have things like liquidations. You have people who have leverage, and they need to be liquidated when their trades go against them. And usually there's a reward to being the liquidator. So people compete to be the liquidator. You need liquidators to liquidate levered traders, otherwise the whole system falls apart. This isn't going anywhere. The second type of benign MEV is arbitrage. Arbitrage is not going away. You have different exchanges that trade the same assets. Sometimes the price differs between them because a buyer shows up to one but not the other. And trading firms will always try to capture that very low risk profit between those various exchanges. There's also what we like to call malicious MEV. Now this is the bad stuff. This is stuff we don't want to see, but is theoretically possible on these chains. That includes things like time-banded attacks or 51% attacks, where you reorg the blockchain after a block has been confirmed to try and capture more trading profits for yourself. This includes things like front-running or sandwich attacks, and it includes things like censoring other people from NFT mints, which we've seen, where people will actually go and buy up the entire mint because they were in control of that block, and they won't let anyone else in. So we looked at the data, and we found that using just one tool on Ethereum called Flashbots, there was $673 million of profit, not revenue, profit, generated on Ethereum alone using just one tool on Flashbots. There are other MEV extraction tools on Ethereum as well, so this sets a lower bound for how much profit has been earned. It's incredibly lucrative, and we believe it will be at the same scale as the high-frequency trading operations as we move towards a future with DeFi. We've also seen a growth in MEV on Solana, as Solana has picked up more activity. And you can see here we have about $10 million of Solana MEV since February 2022. Please note that the time frames of the data that I showed for Ethereum and Solana here are quite different. So you can't necessarily compare them apples to apples. One is a much longer time period than the other. This was a dashboard put together by one of our portfolio companies, Jita Labs. What we find is that MEV cash flows scale super linearly with smart contract activity. This is critical because this helps you understand, where you think more MEV will happen. So where is this honeypot? Where do we go? How do we find it? We believe that DeFi activity leads to MEV. DeFi includes things like exchanges and borrow-lend platforms. Those types of benign MEV that I was talking about earlier leads to trading volume, and that is what presents the opportunity here. And on this chart, we show the sum of exchange volume on Ethereum versus MEV captured on Ethereum. So that blue line is sum of exchange volume, orange line is sum of MEV during that period, and you can see the very strong correlation. And we can say conclusively that DeFi activity leads to more MEV. Now, I want to take a step back and just adjust the terminology here a little bit. We've been talking about MEV because historically, the most important blockchains have been proof-of-work blockchains that have miners. We believe the future is proof of stake. And we are seeing that this week with the Ethereum merge, and the most innovative new protocols being built are all proof-of-stake protocols, whether that's Solana or any of these other new layer ones. We think it's actually appropriate to start calling it VEV, which is validator extractable value. Because in a proof-of-stake system, the validators are the ones who have this power, not miners burning a bunch of electricity. This has a very positive side effect, which is it gives more power to the stakers who actually own the network. On proof-of-work Ethereum or on other proof-of-work chains, the miners are not necessarily owners of the token or of the network, and they don't necessarily share the same incentives. So with the emergence of proof-of-stake systems, we actually inherit some of the really powerful security properties of proof-of-stake to this vector of MEV. And what that really means is if a validator is participating in that type of malicious MEV that I was talking about, the front-running, the 51% attacks, the censorship, then that actually reduces the value of that chain because users are going to leave, right? Like users don't want to be front-run. And so we believe that stakers will not stake to validators who do these malicious things because that erodes the value of the stake, it erodes the value of the network, and this is the inherent security mechanism or security model for all proof-of-stake blockchains. So we believe that power is moving to stakers rather than miners operating a bunch of ASICs and using a ton of electricity. Because the power is in the hands of stakers, we also believe that the value of MEV will also flow to those stakers. Because the stakers are the ones who decide which validator has stake. And the way that you get to extract this MEV or VEV is by being the validator who is leader for the block during that time. So what we expect is that stakers will stake to the validators who offer them the highest yields. They're economically rational actors. And we believe that validators will have to pass through all of these MEV earnings that they have to their stakers. So we believe the stakers will capture the value here. So we believe that as MEV grows, we are going to continue to see MEV extraction tools and other types of infrastructure that are very interesting. But fundamentally, we believe that this exogenous cash flow component will accrue value to the layer 1 tokens themselves because of the dynamics I just talked about around power to the stakers and the value flowing to stakers. So we believe you can establish a lower bound on the value of a layer 1 token by doing a discounted cash flow valuation on the MEV on that chain. So you can actually have a cash flow component for the capital asset part of valuing these layer 1 tokens. Like I mentioned, Multicoin has been thinking about this for quite some time. We're very excited about this, and we're investing aggressively and heavily into different projects that help utilize some of the ideas that I've talked about today. We view the world probabilistically, right? We try to think about the probabilities that certain things will succeed rather than thinking in absolutes. And so we've invested in several projects that we believe can capture a lot of the profits from this type of activity. Of course, you're all familiar with Solana, which is our largest position. And we believe that Solana is the best chain for DeFi. And like I said before, DeFi activity leads to more MEV, leads to more value capture, leads to more cash flow. But we've also made other investments. As someone asked earlier, we invested in a new chain called Aptos. We've invested in a new Cosmos-based DeFi chain called Say. And we are thinking about the world probabilistically. We don't know anything for certain, and we have to incorporate that into our portfolio construction. We are also investing in MEV infrastructure. We announced an investment last year in a network called the Eden Network. We've invested in Jito Labs, which I mentioned, and we've also invested in several liquid staking protocols that we believe will be the main facilitators of MEV distribution to stakers. So with that, I'll conclude the presentation today. Hopefully, we shared some heuristics that are useful as you think about how to value these layer 1 tokens. This has been the culmination of actually several years of thinking about this topic, and how do you actually value this stuff? I think is a really core question. Thank you.